colleagues, it's Tusanam PM Sebata. I'm doing a evaluation on S&P Global. This is the financial data and stock exchange company. It's one of the biggest ones. It's basically it's part of three companies within a monopoly on the stock exchanges. Reason why I'm doing this evaluation, this is one of the stocks I like, and I haven't started liking it now. I did another evaluation last year. It's almost exactly to the day last year when I did another evaluation on this type of on this company, and I'm redoing it again to see where the story is. The reason why I do my evaluations is not for entry or exit points. I do my evaluations to get a better understanding of how the company is currently. Is the model still the same? Is the business process looking still the same, or have things significantly shifted? That's my purpose of doing the evaluation. When it comes to the entry and exit signals, I use technical analysis. And on this evaluation, I'm going to treat it as three parts. This one will be part one, where I'm just giving an overview of my evaluation. Then part two will be based on fundamental valuation. And part three will be technical analysis. On this summarized piece, which I'm doing now as part one, I will include both fundamental and technical analysis, but at a slightly higher level, and keep it very short within the 5 minutes range. But the other ones will be very long and detailed. Okay, why do I like this company? As I said, it's a monopoly. It's one of the few companies, and if you want to trade shares and you want ratings, either you go to this company, Moody's, for ratings. For stock exchange, it's S&P or others, but the others are smaller. That's where you go. That's basically it on the stock exchange, but I'll just open for you to see the big ones. There is only about 9 of them, and the biggest is S&P at 82 billion market cap currently. Then we have CM Group, ICE, and that's it. Those are the three. S&P is the biggest at 82. The other ones are in the 50s. Just to go back and look at some fundamentals on a higher level. When you look at this company with these brief, summarized financials, what will really catch your eye, which stands out, is the long-term debt to equity. It's 18 times. So they have 18 times debt to their equity. So they have little equity at all. But you need to go to the financials. When I do the fundamentals, I'll dig deeper to the financials and show you that this number should not be scary at all. They have lots of cash in hand. Almost 2/3 of the debt which they have, they can pay it in cash now and remain with about 1/3. And this type of business is not going anywhere. So this is not an issue. But most people will panic when the market is crashing and use this as a weak spot for the company. Company has been growing well, 5.8% for the past 5 years, and quarter to quarter it's really kicking it. Its return on asset, good. Return on investment, great. Return on equity was insignificant for these guys, but I calculated it on my evaluation. And something else, yeah. This is the company which keeps doing well. 36% performance for the year, for the half is 51, year to date 25. This is the company which, if you hold it, you know you're going to beat most fund managers by just holding this company, not trading it in or out, just holding it. It's one of the great companies. That's why I like it. And I'll just quickly move to another piece. The street quant ratings, I get these from Think or Swim trading platform. I'll also just rush through it. You can see the share has been going up. This was the Corona dip, but back up again. And these guys have the target at 461. I have it slightly lower than 400. You can see that the performance for the past 3 months, 7% up. For the year, 37%. For the 3 annualized stock price change for the past 3 years, when you analyze that or average it, you keep getting returns of about 31%. So just by holding this company, you can safely say from the history, you're likely to be making 30% returns annually, which beats the standard guys who portfolio managers who return about 20% if they've done great. Most of them their returns are in the teens. So this will be almost like double their returns. These are the companies you need to pick and expect some proper returns. Revenue growth has been doing fine. Last quarter, 12 months, aggregate above 7. In my evaluation, I think I used the 8 or 9. I was debating between 8 or 9, but I think I ended up using 9. Return on equity, you can see some strange numbers. Look at this. These guys, when they did their evaluation, the return on equity was 1,000 plus, because this company is predominantly financed through debt. We'll just not spend more time on that. But yeah, this is one of the reports which I like. I'll deal with it at length in the part 2 of the video. Then doing this evaluation, as I'm saying, this is not the first time I'm doing the evaluation. I did it previously, last year, almost to the date, and my valuation was 213 when the company was trading at 246. Let's just look at it from Think or Swim. This dotted white light was the day when I did the evaluation last year. You can see it's 23 September, and the price was at 246 when I did the evaluation, and my evaluation came with 213 as the target price. The true intrinsic valuation, according to me, was 213. That's where we were, and I'm doing the valuation. So the price was, my value was lower than where the price was, so it was slightly overvalued. But currently, when I did it today. This is the white line for today. Let me just expand that. When I did it today, the 24th, that's where the price was. The price was still at 343.06 as it closed yesterday. I know it's open now, it's about to close. And the value which I got was 373.55. Now the value is slightly higher than where the stock is trading. So according to me, this is undervalued. But as I said, I don't use fundamental intrinsic valuation for entry or exit. Currently, I'm shifting now to the technical piece. Currently, the price is, technically, it's moving downwards. It's closed below the Tick-Sen. Parabolic has flipped over, so I expect this to head downwards. So technically, if I'm investing in this using options, I'll be biased to the bottom, because we had the grouping there at the top there. Those are the groupings. You see, all of them are grouped at the top. The price was topped and started falling. We're grouped there. The price did not go any further. It consolidated sideways before eventually moving back on. But yeah, technically this is telling me we're heading downwards. I'm using the weekly chart. And from the last time when I looked at this company and I did my evaluation, it has since gone up 40% for the year from that date, 23 to 24 today. It's gone 41% up. It's a good company to hold. And we are here now. I expect it to dip. maybe come and bounce somewhere on this cloud, but eventually we'll kick it up. Colleagues, that's just the brief. When I eventually do my part 2s and 3, I will include the source of the information which I used, which are annual reports and the quarterly report, mid-year report, and some of the reports which I get from elsewhere, but these will be shared on the platform. And for those who want to look at my evaluation in detail, they will have all these resources. I'm going to touch a link where I can dump all these for you to see, guys. Yeah, that's my evaluation in summary for SPG, S&P Global. I expect the company technically to dip a bit, then continue upwards. But fundamental intrinsic value, the value I'm getting is sitting at somewhere at 373. And just to show you the valuations, I've said these guys for the street, they evaluated for way up there, 461. And also these guys at FinViz, the value it at target price, they have it at 381, slightly almost close to what I am. I have it at 373, at 381, and all of what these guys are saying, the current price is below value, which I agree with them. But yeah, please watch out for part 2, when I go into depth of how do I get to this value, how do I do the valuation. Just a quick one on the valuation. I also like to sorry about that. I also like to look at the optimal capital structure of a company, whether it's at its optimal capital structure or we can do some corporate restructuring. This one it's not at its optimum, but it's not that way off, just 1% out. So yeah, it's not material. So it's optimized. Their debt and equity is well optimized, which is strange, remembering that I had said if you just look at this, you would think they have too much debt. But doing this evaluation, you can tell now that this optimal capital structure is great for the company. And something also, I look at these ratios, the accounting ratios. Of note, I don't include goodwill in these calculations. I've removed goodwill in these calculations. You'll notice goodwill is sitting at 0 there. I'm not using it that much. But yeah, it goes into the inputs, and we'll talk about this when we talk about the details of this. But just to look at the ratios, the return on invested capital, I've got it at about 124. That's the return on invested capital. But the return on equity is 500%. Reason being, there's little equity these guys have put in. Mostly they are using debt. That's why the return is so high. And non-cash ROE, it's insignificant to negative. That's what we have. But yeah, the details of that, will come to them a little bit later. I'll just touch a little bit on the 10. Let me leave that one for the in-depth analysis. So that will be my analysis, guys. I've done the evaluation this time around for SP Global, and I've got it at around 373. That's where I think is the intrinsic valuation. Currently, technically, we are off that range a bit, heading downwards, and I expect this to continue heading downwards or sideways until things change and we can see a reason to pick up, because this is on its top zones. Yeah, stochastic is up RSI is still a little bit in no man's land. So yeah, I'm expecting a sideways or more of a downwards move in the coming weeks. But I'll see you in the next video. I thank you. It's 2:09 p.m. Sabata. Bye-bye.